Most people believe millionaires got rich from a single massive paycheck or one lucky investment. The truth is far more strategic and accessible than that myth suggests. While the average person relies on one income source, wealthy individuals typically maintain 3 to 7 different revenue streams flowing simultaneously. This fundamental difference in how they structure their financial lives explains why they continue building wealth while others struggle to keep up with inflation. Understanding these structures reveals a blueprint that anyone can follow. The power of multiple income streams. The research on wealth creation reveals a striking pattern. Studies tracking thousands of self-made millionaires found that 65% maintain at least 3 income streams, 45% have 4 streams, and 30% operate with 5 or more. These aren't just random side hustles. Each stream serves a specific purpose in their overall wealth strategy, creating a financial safety net that protects them during economic downturns while accelerating growth during prosperous times. These income sources fall into 7 main categories that millionaires strategically combine. Earned income from employment provides the foundation for most people starting their wealth journey. This salary or wage covers living expenses while generating surplus capital for investment. Business profits represent the second category, where entrepreneurs create value through companies they own or partially control. Investment income flows from dividends on stocks and distributions from funds, generating returns without active involvement. Rental income comes from properties that produce monthly cash flow while appreciating in value over time. Capital gains materialize when assets like stocks, real estate, or businesses sell for more than their purchase price. Royalty income rewards creators for books, music, patents, or intellectual property that continues generating revenue long after the initial work. Interest income accumulates from savings accounts, bonds, and lending activities that earn returns on deployed capital. The strategy behind this diversification goes beyond simple risk management. When one revenue stream experiences a temporary decline, the others continue producing income that maintains financial stability. A business owner might see profits drop during a recession, but their rental properties still collect rent, their stock portfolio still pays dividends, and their bond investments still generate interest. This protection allows millionaires to avoid desperate decisions like selling assets at a loss or taking on expensive debt during challenging periods. The wealth building process typically follows a deliberate sequence. Most millionaires don't start with 7 income streams. They begin by maximizing their primary income source, whether that's a salary, business revenue, or professional practice. This focused approach generates the excess capital needed to seed additional streams. A software engineer might first negotiate raises and bonuses to boost their earned income, then use that surplus to purchase dividend-paying stocks. As those stocks generate quarterly distributions, that investment income gets reinvested to acquire rental property. The rental income then funds additional stock purchases, creating a compounding effect where each stream helps birth the next. The mathematics of this approach explain its power. Someone earning $70,000 annually from a job might invest 20% into dividend stocks yielding 4%, generating an additional $560 in the first year. That seems modest, but after 5 years of consistent investment and dividend reinvestment, that second stream could produce several $1,000s annually. Add rental income from a property generating $300 monthly in net cash flow, and suddenly there are 3 streams totaling over $80,000 combined. The psychological benefit matters too. Having multiple streams reduces financial anxiety because wealth no longer depends entirely on keeping one job or maintaining one business. Strategic business structures and tax optimization. How millionaires structure their businesses and legal entities dramatically impacts how much wealth they actually keep. The average person working as an employee pays income tax on wages plus payroll taxes for Social Security and Medicare, with no ability to reduce that burden. Millionaires operating through strategic business structures legally minimize taxes while maximizing wealth retention. The limited liability company structure offers flexibility that millionaires leverage for tax advantages. By default, a single member company gets treated as a pass through entity where profits flow directly to the owner's personal tax return. However, the real strategy emerges when that company elects taxation as an S corporation. This election allows the owner to split income between reasonable salary and distributions, with only the salary portion subject to self-employment taxes totaling over 15%. A business owner generating $150,000 in profit might pay themselves $75,000 as salary and take $75,000 as distributions, saving over $10,000 annually in self-employment taxes compared to standard treatment. The S corporation structure provides additional benefits beyond payroll tax savings. Owners can establish retirement plans like simplified employee pension accounts, contributing up to 25% of compensation or $69,000, whichever is less. These contributions reduce taxable income while building tax-deferred wealth. Health insurance premiums become fully deductible business expenses. Home offices generate depreciation deductions. Vehicle usage creates mileage or actual expense deductions, and business travel produces legitimate write-offs that reduce the overall tax burden. Millionaires also strategically time their business formation and structure elections. Converting from a standard company to S corporation status mid-year complicates filings significantly, requiring multiple tax returns for different periods. Experienced wealth builders make these elections effective January 1st, simplifying compliance while maximizing annual savings. They document everything meticulously because aggressive deductions without proper substantiation invite audits and penalties that eliminate any tax benefits. The wealthiest individuals often operate through multiple legal entities serving different functions. A holding company might own subsidiaries handling operations, real estate, and intellectual property separately. This separation isolates legal liabilities while creating tax optimization opportunities. Rental properties held in one entity can be rented to an operating business in another entity, creating legitimate deductions for the operating company while generating rental income for the property entity. Intellectual property like patents or trademarks might reside in a separate company that licenses usage to operating businesses, generating royalty streams with favorable tax treatment. The fiscal year selection provides another lesser-known advantage. C corporations and certain types of companies can choose fiscal years ending in any month rather than December. A company with a fiscal year ending in September can pay owner compensation in October that gets deducted against the prior fiscal year's income, while not appearing on the owner's personal tax return until the following calendar year. This timing difference allows deferral of personal income taxes by several months while immediately reducing business taxable income. Investment diversification and long-term wealth accumulation. While multiple income streams provide the cash flow foundation, strategic investment allocation determines how quickly wealth compounds and how well it survives market volatility. Millionaires approach investing with a discipline that contrasts sharply with average investor behavior. The typical millionaire portfolio maintains a relatively simple allocation that might surprise people expecting complex trading strategies. Research shows successful wealthy investors typically hold 60 to 80% in globally diversified stocks and 20 to 40% in bonds and alternative investments. Younger millionaires skew more heavily towards stocks because decades of time horizon allow them to weather market downturns without needing to sell at losses. Older wealthy individuals increase their bond and cash allocations to provide stability and liquidity for potential distributions without forcing stock sales during down markets. The diversification extends beyond just stocks versus bonds. Within their equity holdings, millionaires spread investments across multiple sectors including technology, healthcare, consumer goods, utilities, and financial services. This sector diversification ensures that poor performance in one industry doesn't devastate the entire portfolio. Geographic diversification adds another layer of protection. With holdings spanning domestic markets, developed international markets, and carefully selected emerging markets, the bond portion similarly diversifies across government bonds, corporate bonds, municipal bonds, and various maturity dates that provide both income and principal protection at different time horizons. Alternative investments play an increasingly important role in millionaire portfolios. Real estate provides tangible assets that generate rental income while potentially appreciating in value. Private equity investments in businesses offer higher return potential with correspondingly higher risk. Commodities like gold provide inflation hedges when traditional investments struggle. Art and collectibles can deliver returns uncorrelated with stock market movements while offering enjoyment beyond pure financial returns. The rebalancing discipline separates successful long-term investors from those who underperform their potential. When stocks surge and grow from 60% to 75% of portfolio value, millionaires sell a portion and redirect proceeds into underweighted assets, like bonds. This forces them to sell high and buy low rather than chasing performance and buying more of whatever recently surged. Annual or quarterly rebalancing maintains the target allocation that aligns with their risk tolerance and time horizon. Cost minimization represents another critical element. Every dollar paid in fees and expenses is a dollar not compounding for decades. Millionaires favor low-cost index funds over expensive, actively managed funds because research consistently shows that after fees, most active managers fail to beat their benchmarks over long periods. A 1% annual fee difference might seem trivial, but over 30 years on $1 million portfolio, that represents hundreds of thousands of dollars in lost wealth. The wealth-building strategies millionaires employ aren't complicated secrets requiring genius or luck. They follow predictable patterns of creating multiple income streams, structuring businesses for tax efficiency, and investing with disciplined diversification over long time horizons. The real advantage comes from consistency and patience. While most people chase the next hot stock or quick scheme, millionaires steadily build their systems, reinvest their returns, and allow compound growth to work its mathematical magic over decades. Success comes from implementing these proven structures rather than searching for shortcuts that rarely exist.